Job gains rebound in November. Here to talk about that is Eric Lynch of Scharf Investments, and I'm Lisa Bernhard with Reuters. Eric, the non-farm payrolls report out today from the Labor Department, and it has traders all but certain that the Fed will cut rates later this month. What did we see?
Yeah, Lisa, it was a Goldilocks report because it was strong, but not too strong. 227,000 new jobs, slight beat to estimates, nice wage income growth year over year of 4%, slight beat. But when you take it in combination with the very low October print that was impacted by the hurricanes and the Boeing strike, it kind of averaged out to a reasonably good kind of 2-month period. In fact, what was also slightly good about the report, Lisa, was both September and October jobs were revised higher. So the 3-month average, which is a better way to assess the trend here, was actually 172,000. That's on par with the year-to-date growth, and actually faster than it was in the middle of the summer. So it wasn't too hot, probably to dissuade the Fed from cutting this expected 25 bips later this month. But it wasn't so poor that people are really concerned about a drastically slowing economy.
We're 1 month out now from the election, the Donald Trump victory, and the Republican sweep. Give us the Eric Lynch report card on markets, which have obviously hit some record highs.
Yeah, Lisa, it's the temperature check 1 month in is we have a fever. Animal spirits have kicked in. The S&P had its best equity monthly return in November, up 5.7. Underneath that, defensives were really far behind cyclicals. Cyclicals were up 8%, defenses up just 4.85. Things like consumer discretionary, energy, industrials were all up nicely. Healthcare, for example, as the defensive was flat. Bitcoin, I think, unless you're living under a rock, everybody knows it's $100,000, and that was amazing, up 40% in the month. But also, GameStop, the meme stock du jour of 2021, is up 23%. So if you add it all up together, Lisa, the S&P 500 year to date is up a shockingly 28%.
Okay, Eric, so I'm coming to you and I say I want to rebalance my portfolio for January 1st. Will AI carry the day, continue to do so? And are there any hidden dangers out there that the market may be shrugging off too much?
Yeah, that's the question of the year end, Lisa. We've got a market multiple that's significantly higher than average. In fact, by almost any metric, we're trading between 95 to 99 percentile in terms of valuations versus history. So there's not a lot of room for error here, whether it's geopolitical, whether it's a slower economy than we're expecting, whether it's the fiscal deficit that we've got to address and rein in government spending. But probably the biggest short-term issue really is right now, estimates are that we will be spending $500 billion on CapEx for AI in 2025. Put that in the context. The annual defense budget is about $875 billion. So this is an enormous private expenditure. If it doesn't translate to returns, we don't start seeing that 3 years into the AI story. You're going to start seeing CapEx being depreciated against the revenues of these big mega cap companies. And you could see profits really fail to deliver. So because these companies are so important to the market, if they really don't work out in 25, you could see some market gyrations.